Hi everyone, welcome to episode 7 of this Learn on the Go series, and today we look at the impact of regulations. जी हाँ, सरकारी नियमों का नकारात्मक प्रभाव. I hope I said that right. And in the hot seat today is the Indian Energy Exchange Limited, or IEX. The company's stock price has seen a drop of 30%. Not once, but twice in the last 1 year. This happened first in September of 2024 and again in July of 2025. And both times this was due to some regulatory challenges that the company is facing. However, one positive consequence of this is that the P ratio, which was always between 40 and 50, is now down to less than 30. So we'll try and understand if this can lead to any opportunities. But one area that really caught my attention is the shareholding pattern of the company. And look at this. So in the last 5-6 quarters, while the public shareholding has been coming down, so from 61 to 56, 52, 50, 49, 47, at the same time, the institutional shareholding, which is FIIs and DIIs, that's actually been going up. So again, 5 quarters back, it was around 38. This jumped up to 43, then 46, 49. It crossed 50 in Q4 of FY25. And at the close of Q1 of FY26, we are now at almost 53%. So while public shareholding went down by 14%, the institutional shareholding has actually gone up by 14%. Now, what are the reasons for that? Are the institutions aware of something that we as retail shareholders aren't aware of? I think that will be our quest for today as we look, or rather we hypothesize what might be the reasons for institutions showing a lot of favor towards IEX, especially when there is so much of regulatory uncertainty around. So that will be our quest for today. And yeah, let's begin. Actually, before we begin, please remember this video is not a recommendation of any sorts. This is purely educational. I myself don't hold any shares in IEX at the time of publishing this video. I haven't received any compensation from the company to make this video. Please do read this disclaimer, and for more details, kindly refer to SEBI's rules and regulations for research analysts like myself. All right, let's look at some macro. And as a country, India's demand for power is huge and is growing at about 7-8% in recent times in the last 3-4 years. Also, per the National Electricity Plan, our electricity consumption is projected to hit 2,100 plus billion units, growing at a CAGR of 6.1%. In terms of the business model, and like any other business, there is a producer and a consumer. Producers include conventional generators like coal-based power plants, NTPC, NHPC, independent power producers like Adani, Tata Power, distribution companies, discoms like Torrent Power, BSES Rajdhani if they have surplus power, and renewable energy generators like Suzlon, Renew Power, etc. Likewise, the buyers include state utilities and discoms, which are the largest purchasers of power, large industries like Tata Steel, Hindalco, Maruti Suzuki, Reliance, etc. that prefer to deal directly, and neighboring countries like Nepal, Bangladesh, and Bhutan that are connected to India's grid. Now, because there's a buy-sell transaction happening, the presence of a middleman becomes all the more important, and that's where power exchanges come in. So a power exchange, as the name suggests, is a platform that facilitates the trading of electricity. You can think of it like an auction house like eBay, wherein there are multiple stakeholders who come and bid for electricity, both in terms of price and quantity. And a power exchange is someone who not only helps with price discovery, but also helps in facilitating that transaction. All right, let's go a bit deeper. And the demand for electricity is of 3 types. A, there's of course a long-term requirement, which is where discoms get into long-term contracts. That's typically around 25 years. Then there's medium-term, which is up to 5 years. And thirdly, short-term contracts of up to 1 year. As one can see here, power exchanges tend to cater primarily to transactions that are very short-term in nature. Why is that significant to our investing thesis? There are a few reasons. Number one, while the overall demand for power is growing at 6-7% currently, which itself isn't a bad thing, but figure this, the short-term power market is growing at a much higher CAGR of 18%. In fact, the proportion of short-term power transactions as a percentage of the total electricity generated, which was a tad lower than 10% in FY20, is now closer to 13%. Another reason why the short-term power market becomes hugely important are the variations due to unpredictable weather conditions. As one can see here, in 11 of the last 24 months, there's been a plus minus 5% variation in the short-term demand estimate and the actuals as shown by the black bars. And thirdly, there's the renewables market, which is increasing and is expected to be about 60% of the overall electricity generated in our country. But because this involves the wind and the sun, over which we have absolutely no control, renewable energy becomes a bit variable and uncertain. This can lead to short-term spikes and falls, which is exactly where a power exchange comes in. We have three of them in India: IEX, that is the Indian Energy Exchange; PXIL, that's the Power Exchange India Limited; and HPX, that is the Hindustan Power Exchange Limited. These power exchanges are regulated by the Power Market Regulations of 2021, and their market share in total electricity generation is on the rise. Now let's quickly go through some of the products they offer. So firstly, there's something called a day ahead market, or DAM, wherein participants place their bids and offers just one day ahead of physical delivery, and this is done in an auction format. IEX has a monopoly in the segment with a 99% market share, as is the case with real-time market, or RTM, where delivery happens just 1 hour after the auction closes, which essentially helps in managing power supply volatility primarily on account of renewable energy sources. Between DAM and RTM, this is about 75% of the company's electricity volume. So if anything were to happen to either of these, then IEX would be in a bit of a pickle, which is something we'll discuss when we come to regulations. The next offering by these power exchanges is called Term Ahead Market, which is a range of products like intraday, day ahead contingency that help participants manage their electricity portfolio across different durations. And finally, there's the Certificates Market, which is growing by over 100% for IEX and is a way of promoting energy efficiency compliance in India with the trading of renewable energy certificates, which are also called RECs, and also energy saving certificates. Also, just a quick word on IEX. I got this from their investor presentation, and some of these numbers are truly impressive, especially the fact that they have over 8,500 stakeholders in their ecosystem with 5,700 plus commercial and industrial users. All discoms are a part of IEX, and it works with thousands of conventional electricity generators and an even higher number of renewables generators. And although it doesn't say it on the slide, IEX has a dominant position in the short-term power trading market with an 84% market share. And as we saw earlier in the presentation, it has a 99% market share in the DAM and RTM segment. As to why this market share is so high, Mr. Satyanarayan Goyal, the company's chairman and managing director, attributes it to a bunch of factors such as the technology platform, IEX's product offerings and the segments they are present in. And with First Mover, they built a lot of awareness, and with 7,000 plus stakeholders, that's a lot of awareness building. IEX is also on the advisory board of more than 12 state regulatory commissions, which definitely helps. They provide a lot of data analytics that helps their clients take better decisions. And per the chairman, their IT infrastructure is also very secure with zero penetration from cyber attacks till date. One should also examine how IEX makes money, and please note the company makes a lot of money with an EBITDA margin of 89% for FY25 and a PAT margin of 65%. A lot of this money comes from transaction fees, wherein IEX charges a fee of 4 paisa per trade, that is 2 paisa per unit on the buyer side and 2 paisa per unit on the seller side. Okay, let's understand this mathematically. I am on one of the investor presentations, and the electricity volume that was traded via the IEX platform in FY25 was 121 billion units. So that's about 12,100 crores. And okay, let's just open the calculator. Okay, so 12,100 crores and we multiply this by 4 paisa. So 2 paisa plus 2 paisa. So this comes to 484 crores. Now let's compare to what was the revenue for IEX. Yeah, profit and loss. Now see, the entire revenue for the company was 535 crores. So 484 crores out of a total sales of some 535 crores is a big number, which effectively means that a lot of the revenue that IEX generates is out of this trading of electricity. And if anything were to happen to this 4 paisa, 2 paisa plus 2 paisa because of regulations or because of competition, then it will have a big bearing on IEX's future profitability. So that's something one should look out for. And yeah, now that I've said it twice, let's address the elephant in the room, which is regulations. Now, IEX operates in a highly regulated environment. In fact, all three, IEX, PXIL, and HPX, these are all regulated by the Central Electricity Regulation Commission, the CERC, under the Power Market Regulations of 2021. On the plus side, these regulations have helped power exchanges in terms of driving volume and liquidity. For instance, a recent amendment to the late payment surcharge rule now requires all generating stations to offer their surplus power to power exchange platforms, which in turn increases the sell side liquidity on IEX. Likewise, in May of this year, the CERC issued draft guidelines for virtual power purchase agreements, recognizing power exchanges as authorized platforms for sale of electricity by renewable generators. That said, a major regulatory change that will have a bearing on the future performance of IEX is what is called as market coupling. It's the reason why the company's share price crashed by 28% on the 24th of July this year after the CERC formally announced its decision to begin the implementation of market coupling in India. And what is market coupling? Well, currently all three power exchanges, they operate independently, as in they collect, buy and sell bids on their own and consequently come up with their own market clearing price or NPC. In fact, in this table here, someone has painfully compiled the per unit price of electricity across all three exchanges across years. And if one looks at just the FY24 entry, we can see the discrepancy in price. 5 rupees 16 paisa on IEX, 9.71 on PXIL, and 10 rupees on HPX. The reason for this variability most likely is the majority of trading volumes being concentrated on a single exchange, that is IEX, while the other two exchanges barely have any volumes of note. If one examines FY24 at the bottom, specific to DAM, we can see 53.39 billion units through IEX, while PXIL and HPX transacted barely 1/100th of that number. So that's the discrepancy that market coupling aims to solve for, and per this revised model, all buy bids and sell bids across exchanges will be aggregated and matched to discover a uniform market clearing price or MPC. This means there'll be only one price for the electricity at any point of time that's traded through these three power exchanges. And when implemented, the fear is that power exchanges and especially IEX will lose its price discovery USP and will be rendered merely as a platform where buy and sell bids are collected and power dispatched to the buyer. I won't go into the methodology, but to level up on the pros and cons, market coupling is very likely to rationalize prices on exchanges, which will have a positive impact on the purchase cost of power. Further, it is likely to promote product innovation and improved quality of service, with more players likely to enter the fray and challenge IEX for market share. Some arguments against market coupling include the presence of uniform pricing due to IEX's dominant market share, which means coupling might add little value. And since India is already on an interconnected grid, price differences only arise from the transmission congestion, which was just 0.09% in FY22. So it's basically IEX versus the rest. And in that context, PXIL and HPX has a strong incentive to ramp up their public relations push to pressure the regulator into fast-tracking market coupling. From an IEX perspective, the management views market coupling as potentially detrimental, as in it will kill innovation and competition, and that coupling is completely unnecessary. Now, as it stands, the CERC has issued an order. This was done sometime in July of this year to initiate market coupling implementation in the day ahead market, that is DAM, by January of 2026, with RTM to come up sometime later. All right, let's look at the financials now. And over the last 10 years, the sales have jumped up from 170 crores to 535 crores. So that's a 3x jump. And I'm taking the standalone numbers here because there's not too much of a difference between consolidated and standalone. So with standalone, I get a 10-year width to look at. Uh, so while the sales have gone up by 3 times, we see that the operating profits have gone up by about even more, about 3.5 times. And the net profits from 100 have gone up to over 400. So that's a 4x jump. And so has the EPS, which has jumped up from 1 rupee 16 paisa to 4 rupees 65 paise. Of course, even though the sales has been nice and upwards, the sales growth has been a bit more variable, with certain years where there was even negative sales growth happening. This one in FY16 and also in FY23, while sometimes there were nice spikes of even 34% in a singular year. That said, there is no denying that IEX is a hugely profitable company with more than 400 crores of net profit. In terms of debt, there is absolutely no debt. No long-term borrowings which are there, which obviously means that from a P&L perspective, your interest is like nothing. The company is also very asset light. Look at this, it's hardly 87 crores of assets, which means the depreciation itself is at the lower end. So essentially what we have is a company that is asset light, has robust technology, zero debt, steady growth. It is highly profitable, has excellent margins, and is a very important player in the power exchange market. Of course, with the regulatory challenges looming around it, more for IEX rather than PXIL or for HPX, it is very interesting for us to understand that why are institutional investors lapping up more shares of IEX while the public is completely running away from it. So that's what we really want to understand now. Of course, I should mention that I haven't spoken to any of the institutional investors. So what I'll try and do is to basically theorize, to hypothesize what might be the things which are there and what all I have realized or discovered through this process. Let's start with point one. And a question that is definitely bothering me is market coupling likely to be as effective as the stock market expects it to be? In this context, I'd like to point out to a shadow pilot that the CERC had asked the Grid Controller of India to conduct and to test whether the market coupling exercise could actually improve efficiency. This pilot, conducted between December 2024 and March of 2025, showed modest results with the day-ahead market, with overall welfare increasing by a negligible 0.3%, while the real-time market saw an insignificant gain of just 0.1%, or actually was 0.01% in welfare and volume increase. Now, obviously, a simulated gain of 0.3% or 0.01% is very unlikely to inspire any confidence amongst the supporters of market coupling, which is probably why some of the brokerages and institutional investors are not very bothered with what's going around. JM Financials is one of those research houses that in its June 2025 report said, and I quote, "We believe that the risk reward is not in favor of nationwide implementation of MC in the near future." In fact, the brokerage went on to say, and let's make it point number 2, that is the implementation timelines. And what JM Financial says in another report is that the CERC's January 2026 target is very ambitious. And given the amount of structural changes that are needed to be made in terms of infrastructure, software, compatibility, data sharing, etc., they feel implementation will not be possible before December of 2027. That's over 2 years from now. Number three, hypothesis number three takes us back to the operating model of IEX. And the fact is, or at least that's what the management is saying, is that even if the price discovery part is removed due to market coupling, there's a lot more that IEX offers which will continue to be bigger differentiators for the company as compared to their competitors. So things like their advanced technology platform, which the company has developed over the past 17 years and is likely to be more robust as compared to other alternatives. IEX also offers its clients a number of tools like EnergX, a web trading platform that makes onboarding, bidding, and reconciliation simple and fast. For large customers, IEX provides automated APIs for bidding and reporting. IEX works closely with clients and also regulators, often advising them and helping them with data and insights. A lot of these offerings, these relationships have been built over many, many years. And mind you, we're talking about some 7,000, 8,000 stakeholders, 75 distribution companies, thousands of generators, both conventional and renewables. And if you've been in business, I'm sure you know the value of connections and network. That said, it would be wrong to assume that the competitors are just going to sit idle and not do anything. Remember, they have the regulators' support in the current environment, and it is very likely that what is an 84% market share for IEX currently will probably come down to maybe 60% over the next 2 to 3 years. So maybe this is what the institutional investors are really looking at. A, an exaggeration from the stock market in terms of what market coupling can do. Secondly, the implementation timelines, and as per one brokerage, MC implementation is still a good 2 years away. And thirdly, there are the qualitative factors which isn't very easy to replicate. That said, one thing we haven't discussed yet are the growth factors, as in what more can IEX offer in the future. It's an important question because ultimately what you and I want to know is that in spite of all these regulatory challenges, can IEX continue to grow at 15-20% per annum for many more years as it has consistently done over the last 10 years? So let's understand this, and understandably, the first growth factor is the projected increase in power consumption, with the Power Ministry expecting it to grow to about 2,133 billion units by FY32. Incidentally, the IEX management gave an even higher number in their latest earnings call. They have pegged India's power consumption to reach nearly 2,500 billion units, so a growth rate of 7, maybe 8% per annum, all thanks to industrialization, railways, electric vehicles, rooftop solar, and data centers. Either ways, the growth is strong and visible, which augurs well for the power exchange sector. And remember, it's the short-term market, which is where IEX and the others are truly present, that has been growing at a higher CAGR of 18% on a historical basis. All right, a second growth driver are the new products that IEX aims to introduce based on upcoming regulatory developments. Some of this includes extending TAM, that is the term ahead market, to up to 11 months, launching green RTM, for which IEX has already filed the petition with the CERC, recognizing power exchanges as authorized platforms for sale of renewable power under VPPAs, that is the virtual power purchase agreements. This is under draft guidelines currently. And then of course there's the massive potential of renewable energy certificates with favorable policy frameworks like the removal of the REC floor price, enabling fortnightly trading and potentially stricter penalties for non-compliance with renewable purchase obligations. IEC on its part anticipates a 25 to 30% growth in the REC segment. A third growth driver, and a rather important one, is market deepening, which simply means an expansion in IEX's total addressable market and revenue base. So as I said earlier, the electricity traded today via power exchanges is only a little over 7% of the country's total power consumption. But pleasantly, per a report by the Ministry of Power, the spot market share can increase from the current 7% to around 25% of the total electricity generated by 2030. This deepening is actually considered necessary for efficiently integrating the high and growing renewable energy capacity, which in turn creates opportunities for IEX through new market models and products related to volatility management, short-term capacity contracts, VPPAs, CFDs, or contract for difference, etc. You can read specifics on the internet, but the possibility of tripling the addressable market from where it is currently is definitely something to look forward to for the management and for the shareholders of IEX. The fourth growth driver is the gradual increase in renewable energy within the supply mix. And as seen here, the share of renewables, that is solar, wind, has increased from 10% in FY20 to 14% in FY25. And given its strong focus, this is likely to increase to 35% by FY32. This growth also brings in a fair amount of uncertainty, as the demand for renewable energy also depends on weather forecasts as well as unpredictable and difficult to model factors. So essentially, volatility is the driver, and I really love this image that indicates that the more a state incorporates renewables in the supply mix, the higher is the need for a power exchange, especially to manage their short-term market purchases. Gujarat, Tamil Nadu, Kerala, Rajasthan, 30% of the electricity in these states come from renewable sources, and correspondingly, the use of a power exchange is also higher at 10%, when the national average is more like 7%. And the fifth and final driver of growth is what IEX is doing in terms of diversifying its offerings. There are a couple of things that these guys are up to. The first is the building of the Indian Gas Exchange. IGX was launched in the year 2020 and is India's first nationwide online trading platform for natural gas. The exchange itself is regulated by the PNGRB, that is the Petroleum and Natural Gas Regulatory Board, and growth here is dependent on the government realizing its vision of increasing natural gas consumption from the current 6% to about 15% by the year 2030. Of course, infrastructure development like LNG terminals, the pipeline network, etc., as well as the price of gas will be the key catalyst here. And if these were to click together, then the company expects IGX to be as large as what IEX is currently today. In fact, Q1 of FY26 was an excellent quarter for IGX, trading almost 25 million MMBTU. MMBTU stands for metric million British thermal unit. So figure this, while in the last 4 years, so that's 16 quarters, IGX managed to trade some 150 million units of gas, but now in just a single quarter, they managed a solid 25 million. This definitely is a good sign. And also in terms of profitability, IGX achieved a PAT of 14.1 crores, which is a good 13% of the overall PAT that IEX achieved for Q1 of this financial year. Similar to the gas exchange, the company incorporated the International Carbon Exchange ICX in December of 2022 with the objective of promoting voluntary carbon trading. Now, India happens to be a significant seller of voluntary carbon credits. It controls anywhere from 15 to 20% of the global supply. And per this report, between 2010 and 2022, India did account for 17% of the global supply. ICX has also been accredited as India's sole issuer of IRECs, that is International Renewable Energy Certificates, and in just the first quarter of FY26, it issued over 44 lakh IRECs, while in the entirety of the last financial year, it had issued only 59 lakhs of them. That said, the revenues are quite low presently, just a little over 1 crore for Q1. But these are very early days for this initiative, and it'll be interesting to see how IEX expands this, much like how it has done with its core power exchange and also IGX. Alright, so much like the previous video on tips music, this one was pretty long. It requires a lot of patience to go through videos such as this. Even the views aren't that good. But I think at least in terms of the return per minute invested, these videos offer a lot more value than probably what a podcast can offer, or, you know, those scam videos, ki ye scam kaise hua, etc. Those are all more of masala videos, but I think these videos can be a lot more helpful to you. As far as IEX goes, I think institutional investors are looking at it more as a contrarian bet, in the sense that the price has now been dented to a level where the stock itself might be a little undervalued. These are not my words. I'm not giving any kind of recommendations here, but I'm kind of theorizing that this is what institutional investors are looking at, and it'll be great if you can do the same thing. At least, you know, give it a thought, mull over it, try and find pros and cons around it. And you don't have to agree with anything that I've said in this video. I'm sure there are enough flaws in this video. So do your own level of research, and it'll be great if you can spend some time on it and let me know in the comments section whether you think what I at least am kind of theorizing, whether that's correct or not. And if there are any holes in it, then please let me know that as well. Once again, thank you for your time. As always, a pleasure putting this together and presenting it to you. And I'll see you very soon. Bye-bye.